Good morning. Welcome to the BF Anderson Report, technical report for June the 6th. Look, we've got a lot to get into. I'm going to go right into the charts. Now, we know that May was probably the most difficult month of the year, and we're seeing here the NASDAQ, which has broken below both the 50 and the 25-day moving average. Now, we looks like we could have made a low here and are trying to work our way back up. We need to get back above the lower moving average before we become very optimistic. Now, volume has been, yesterday's volume wasn't exactly above average. 2 days ago we had down volume that was pretty high, so we're not seeing what we would call a follow-through day. Follow-through day is where your upside volume exceeds the downside volume. But I think, this correction may have run its course. I'm not going to predict anything, but I do feel that we're starting to see signs, and we'll see it in the charts here, that maybe the worst is over. Let's just kind of look, and you have to make your own mind up on that. Now, here is the critical indicator, the 35-week moving average, which is very similar to the 200-day moving average, but we're looking at it on a weekly basis. We did break below it. However, with the rally we've been getting for the last 2 days, we're back above it. Now, it's really important that this stays above the 35-week. If it goes below the 35-week for 2 consecutive weeks, I'm going to have to become much more defensive than I am now. I'm pretty defensive, but I would have to become more defensive. Advanced decline line, as we both know, it's pretty much flattened out. We talked about this last week. You really want to follow the trend of the line. It has not gone into a downtrend, but it's more of a sideways trend. The high-low index, we're not getting very many new highs. However, it is improving. The number of new lows on the New York Stock Exchange, as you can see, really kind of got up there. We went to 250 new lows the other day. Yesterday we had 57. The day before we only had 20. So, this needs to settle down. We don't want to see anything like this. On the long-term indicator, the 10-20, which is the 10-month versus the 20-month, we've pretty much held the 20-month moving average and have bounced back up. This continues to be in an uptrend, however, is showing some signs of weakness. We need to see this market get going. Now, I think the most important thing to realize, and this has to do with, is the horse already out of the barn type of thing, which is where we've got extreme fear here. With the put-call ratio, we have extreme fear. Now, usually markets make bottoms when you've got extreme fear, just like markets tend to make tops when you've got extreme greed. Now, on your report that I've got enclosed, you'll notice that the fear-greed index, that is a calculation on 1 to 100, is currently at 26, which is fear, but realize extreme fear is 25, so we're not that far out of it. But I would pay attention to the put-call ratio. I think it is saying that maybe the worst is over because the horse is already out the barn, basically what it says. Now, I think this is really an interesting situation. This is the 200-week moving average. Since 2011, we've come down and hit that moving average, and then we rally, make a new high, and then we have a correction. Then we rally and we make a new high. Okay, and so here we go again on June 2016. We pulled back close to the 200-week. We then rallied to a new high. Then we had a correction. We're doing the same thing here. Last year we pulled back, got real close to the 200-week. We rallied to a new high. Now we're having a correction. But notice that every time it gets down to this 200-week moving average, we tend to, once we turn, it tends to rally to new highs. Let's just hope for that. I think that's reasonable. Now, I went back and just to kind of make a point on this. Now, remember what this looks like. I mean, this looks very clear, very uptrendy, looking fine, no problems. I went back and just did a long-term graph on the very same 200-week. This was 2000. You can see that, it broke the 200-day. You made a low, then you rallied back above it, but then you made a lower low, and then you rallied back. You were in a definite downtrend. We don't have anything like that right now. And if you go back to 2008, it's the same scenario. You're breaking below that 200 week. So if we break below the 200 week, we may be going into a bear market, but I'm not going to predict. I'm not going to extrapolate because that's a big mistake. But we don't have anything that looks like this right now. Now, on the small caps, which is very important, we are holding 1,500 on the Russell 2000. We did break it for several days, got down to 1460. Now we're back up to 1506.79. We really need to see these small caps get going. That would be real important. On the Value Line Geometric Index, I think it's interesting to note that we pulled back into the box again. But if we hold here, we're making a higher low than the prior low. And you can see the uptrend. We made a low in 09, rallied, higher low, rallied, higher low, rallied, higher low. Now we've rallied again, but then we pulled back. We really need to see this index get going as well, just like the small caps, very comparable. Now, interest rates are doing some pretty crazy stuff right now. And the word is that the Federal Reserve is going to cut interest rates. Would not be surprised. I think it's a possibility. We have to kind of take our hat off to Donald Trump. He told Powell that he needed to cut interest rates, and it looks like he's going to do it. But look what's happening here to the 10-year bond. I mean, it's really coming down to levels we haven't seen in a while. Now, this is something that the media talks a lot about, which is the yield curve. I think it's interesting that everyone's saying the yield curve is going to invert. Now, what I've got here is the 2-year government bond compared to the 10-year government bond. And an inversion would be if we go, to zero or so forth. But everybody, once we start getting down here, starts predicting that we're going to invert. Well, look what's happened. All of a sudden, boom. This is kind of telling me that the market's discounting something to do with the Federal Reserve cutting interest rates. I really feel that way. All right, let's get into the top 5. This is Array BioPharma, which is a pharmaceutical biotech. You can see how nice the uptrend is. It gapped up, uptrend. That's a beautiful chart. This is DMC Global, which is an industrial company. Nice flat base, a breakout above the base on abnormally high volume. This looks good. Copart, which I believe is an auto parts. Some of these our list has changed so much. I got to go back to school on these companies. Again, you got a gap up on really heavy volume, got a gap up, and now you start to see an uptrend forming after the gap. What this is all about, most of these gap ups are companies that announce earnings, and the market likes what they're seeing, is what it boils down to. Now here's Harris Corp, which is an electronics company, mainly a government contract. They're real big into radio type technologies. Again, you can see here you got a gap up, and real steady uptrend. This stock looks real good. Roku, we own this stock. It's one of our biggest winners. They announced earnings. The market liked what they heard. The stock's in a very strong uptrend. Yesterday, an analyst with Guggenheim raised the price objective on the stock to 125. Stock broke out above 100 and looks fantastic. This is a pure play in cutting cable and going to streaming. I have a Roku and I really like it. Now I find that it's more young people have them than the older people, because the older people say they can't figure out how to work them. Well, they will, because you're going to save so much money on your cable. Well, that's it. Let me know if you have any questions. Thank you very much.